It's great to have so many people back in person here. We obviously suffered a little bit through COVID. Then last year we managed to organise it on the same day as train and tube strikes, so we had quite an empty room last year. So it's good to have people here, and also welcome to everybody online. Pretty much most parts of the globe, hopefully, and those that are in the right time zones and stuff as well. So welcome to everybody there. For those who don't know me, I'm Ollie Chinook, so I head up the betting and gaming team at BDO. And so today, I've got a new photo as well, actually. It looks a lot more like me. Someone was heavily critical of my photo the other day, so I have changed it. So that's the big news for this year anyway. So moving on to agenda today and what we're going to be covering. So as we usually do, we're really going to try and focus as much as possible and keep it fairly high level. We've got sort of 2.5 hours today. So going into the real minutiae detail just won't, probably can't do areas justice. So the slides will all come around afterwards. We'll have all the presenter details on. So please do get in contact with them if there's anything that you want to pick up. We'll go through in more detail. So obviously I'll kick off and just get a bit of a sort of overview of some performance of the sector in the year, and then to sort of look at 5 things that I think are to watch in the year that are sort of on my radar really. Following that, we'll have Chris, who's going to give an accounting update. There is unfortunately quite a bit of change coming through in IFRS, and there's quite a major overhaul in UK GAAP as well. So a few bits to just sort of watch out there. We've then got sort of 3 fairly sort of quick, sharp sessions on sort of the regulatory side. So we've got Clarinda covering AML and responsible gambling. We've got Vernie, who's covering the new AI Act, and then Louise, who's going to give an update on some of the data protection changes. We've then got Evan and Francis, who are going to cover sort of bit around digital governance and slightly wider on controls. We're seeing, particularly driven through licensing, regulatory changes, and also UK corporate governance code changes, quite a lot of movement in this space. I thought it was quite helpful just to give an update of what we're seeing there. After the break, we've got an M&A panel, hopefully. We've had a bit of chop and change on this. We've got David Shapton joining us from McClure, who was a very late sub-in when our previous panelist dropped, unfortunately, ill yesterday, and Ivor Jones from investment bank Peel Hunt as well. I'll moderate that along with another Ollie from our corporate finance team. And then to wrap up at the end, we've got four people from our tax team. We're just going to have a general discussion, overview of some of the key changes in tax that we're seeing this year, what's coming down the track for next year, and just a bit of a slightly deeper dive into Brazil, because obviously we're aware that's quite a key area for us. So we'll do our best to keep to time. If you have got any questions, please, if you're online, please do post in the chat. I say the presenters will be around for lunch, for some lunch afterwards, and we could always contact going forwards. So just quickly on to some performance in the year. A few years back, we coined this frame BAGPIPE, which is betting and gaming performance in period, EGR, which is pretty awful, to be honest, but we have retained it for the current year. So I think as some of you may know, we do a lot of work with EGR, which is the industry sort of trade body, media business. And so each year we look at the financial performance of the top 50 B2C online gaming companies. And from all that data that we gather, we produce a financial ranking, which EGR then used to do the overall Power 50, which was published pre-Christmas. So this is just looking at the sort of the revenue growth in the year. And as you can see, it's still pretty impressive growth, to be honest. So it's maintained at about 15% or so growth in the year. Particularly that's coming from, or continues to come from, US growth, LATAM growth, and a little bit of growth in sort of Africa as well. I think going forward into 25, probably see a slight softening of that, I'd expect. Potentially some growth areas potentially in LATAM, but Brazil's a bit of a wait and see, as we'll sort of hear later on, I think. So how's that converting into EBITDA? You can see that actually what's positive is that 15% growth that we're seeing across revenue is converting straight into EBITDA. So we've seen about a 15% growth in sort of cumulative EBITDA there. The positive, I'd say, is that if you look at last year where we had revenue growth of about 20% across the sector, that wasn't quite dropping down into EBITDA, where that was coming in at about 15%. And primarily, I think that's because some of the US losses have reduced given the sort of high startup costs and high marketing costs that we saw there. And then finally, we do look at sort of a market capitalization, private company valuation piece, and this is a snapshot at a point in time, so it's not always wholly representative of today's position. But despite some of the headwinds we've seen on regulatory, tax, etc., the sort of market caps and sort of transaction sizes and transaction multiples have pretty much held up since the same point last year. Again, it'd be interesting to see how they sort of change going forwards. Okay, so this is just my personal view, my 5 things that I guess that I'm watching for 2025. So we talked about the US gold rush previously. I think we're going to see the same in Brazil. I mean, as people be aware, there's a lot of marketing spend, a lot of money going into Brazil at the moment. And the question is, are we going to see the same thing that happened in the US happened in Brazil? Sadly, I think a few people will get a little bit burnt there. It's a slightly different position to the US because essentially you're taking, well, from my view, a very mature market already and just regulating it against the US. It's a lot of start from scratch position in certain states, etc. So I think what happens there is going to be very, very interesting. You may well see some of the marketing spend that's previously gone into the US so obviously be diverted to Brazil. So you may see a bit of profitability there as people try and offset positions, but definitely an area of focus. With all the sort of noise, I guess, coming out of LATAM, Brazil, etc., I think the one that's sort of sneaking up on the sidelines a bit is Africa. So we're seeing increasing sort of regulation there, further payment solutions coming through, etc. So I do think, with the focus on LATAM, that there may be just a bit of opportunity for some further growth in Africa as things develop there. So on to number 3, one of my points that I said I wanted to watch last year was how ESPN got on in the US, trying to crack the market there. I was speaking to someone just before actually, and it's like, I think that there's been a very heavy focus on, or what it certainly has proven to me is you can't just take a brand and expect it to deliver the numbers really. So thank you to people I'm speaking for reaffirming my sort of view on that really. So yeah, they've got to about 3% sort of market share, slightly less based upon latest numbers, but I think obviously they'd expect them to have grown a bit more in that and maybe made a bit more of a dent in the large sort of two, 3 market leaders there. So for 2025, 2 to watch there. I think it's going to be interesting to see how Fanatics get on and also how DAZN get on. Clearly, they're building up sort of media, sports rights, etc., and just how they can convert that into the betting arms is going to be of interest really. Number 4 there, and I think there'll be maybe some debate on this later on in terms of the panel, is just from a UK capital markets perspective, we haven't seen significant activity over the last few years, partly for obvious reasons. But just I think with some of the challenges we've got there is just what is the UK capital markets? How is that going to help the gaming sector? What can happen going forwards? And finally, who will land Luke Littler? So he turns 18 next week. I'd imagine that someone may know the answer in this room already or online, but I'd imagine some of the gaming companies are going to be quite hot on his tails as to who can land him as their ambassador. So yeah, that's the other one to watch. And finally, before I hand over to Chris, it's just to say, obviously, myself, Daisy, and Ollie from our corporate finance team will be at ICE next week. Again, I think it's going to be interesting to see how that goes in year 1, moving from London to Barcelona. But say if you are there, if you do want to meet up, then please do get in touch. So with that, hand over to Chris.
Good morning, everyone. I do recognise quite a few people in the room today, but for those of you who don't know me, my name is Chris Isaac. I'm a senior audit manager in the betting gaming unit here in BDO. I joined BDO 12 years ago and have had the luck of working with Ollie a lot since then, working on UK and US listed businesses in the gaming space. I don't have a new picture, so I'm going to get that up. Today I'll be guiding us through an accounting and financial reporting update, covering some upcoming changes from IFRS and UK GAAP, I'll be talking us through some FRC annual review comments on corporate reporting, and I'll be covering some corporate governance changes as well. Ollie did mention it, but we will be showing the slides after today. As we go through, there are quite a lot of references and links through to external webinars. So I'll be giving us a bit of a flavour of some of the upcoming changes, but there are a lot more details and some practical examples if you go through and look at the webinars on those links. So let's start with a accounting update. So on the screen now we have some IFRS developments which have come into effect from the 1st of January 2024. So these affect year ends ended 31st of December 2024. The first one we have is amendments to IAS 1 relating to the classification of liabilities as either non-current or current asset liabilities. So I'll be covering that in a bit more detail shortly. We then have two more sort of minor changes to IFRS which have come in this year, which relate to IFRS 16 and the sale and leaseback conditions, and IAS 7, a change to the statement of cash flows, specifically around supplier financing arrangements. Those two second and third amendments are more minor, as I've said, so I'm not going to cover those in detail, but they are included in the webinars throughout the year, and it's just been raised for awareness if those transactions are something that your business is relevant for. We'll then look through some standards and amendments that are not yet effective and come into effect in January 2026 and January 2027. And we'll be covering those in some more detail. So they are amendments to IFRS 9 relating to the classification of financial instruments, and then two new standards, IFRS 18 and IFRS 19, which are around presentation and disclosure of financial statements and subsidiaries without public accountability disclosures. So kicking off with changes to IAS 1, which, as I mentioned, come into effect from the 1st of January 2024. These amendments specifically look at the recognition of liabilities as either current or non-current. The main change now being that in order for a liability to be recognised as a non-current asset, the company must have a substantive right to defer settlement of the liability for greater than 12 years, and significantly that right must have existed as at the reporting date. So that's particularly relevant when thinking about external debt with conditions or covenants, and thinking about and assessing when those covenant compliance tests are occurring. It is also relevant when thinking about covenant waivers. So if or not you have or have not received that waiver pre-reporting date, will have a big impact on whether that debt can be recognised as current or non-current. So moving on to cover amendments which have not yet come into effect but are sort of more forward-looking. So changes to IFRS 9, particularly the derecognition of financial liabilities settled through electronic transfers. That's the main and most significant change for the gaming industry. The amendment clarifies when electronic payments can be used to settle or recognised to settle liabilities. So previously that would only occur at the point at which the cash actually gets paid. IFRS 9 now says that recognition can happen at a different point within the payment process. It is an accounting policy choice, so it's not a mandatory thing. And in order to be able to do it, you do need to follow the exception criteria that's set out in the box at the bottom right of the screen. As I mentioned, that is a criteria and a choice that can be made. It's not mandatory. And I think it's particularly relevant when we think about how we're recognising the settlement of payment processor debt and also player wallet transactions. There has been another change to IFRS 9 in respect of the classification of financial assets, specifically those that are linked to ESG-linked features. However, that is less of an impact in the industry. We've included the slides for information purposes, but I'd suggest that people read through that at their own convenience. And that leads us on to two brand new accounting standards, so IFRS 18 and IFRS 19. IFRS 18 is a brand new standard on the presentation of disclosures within the financial statements. It doesn't actually change the recognition or measurement within the financial statements more than look and the feel of the financial statements, particularly with reference to the profit and loss account. A lot of IAS 1 will remain as it moves over to IFRS 18. So all of these areas will remain consistent as it moves into IFRS 18, but I'll concentrate more on some of the changes that have been made. So there are four key changes from moving from IAS 1 to IFRS 18. So the first three are categories in the statement of profit and loss, line items and subtotals in the statement of profit and loss, and label aggregation and disaggregation. Now, all three of those are specifically linked to how the profit and loss looks. So there will be new categories within the profit and loss and new subtotals. And there's a lot more stringent rules around where items within the profit and loss can be categorized. And then the fourth change is around management defined performance measures, or previously known as alternative performance measures. The big change here is that now, in order to have management defined performance measures in your financial information, so that could be in the annual report, or it could be through other commercial or marketing information that you put out to the market, you are required to have a reconciliation within the financial statements that reconciles from that non-GAAP measure to an IFRS measure. So that is quite a significant change. And then our final IFRS development and another new standard, IFRS 19. So this is subsidiaries without public accountability and disclosures, which in essence is simplifying or giving companies the option of having some exemptions within their financial statements, sort of akin to FRS 101. This hasn't yet been endorsed in the UK and would represent an alternative to FRS 101 should it be endorsed, but it can be used more widely than outside of the UK. At the moment, we don't know how this is going to be reflected in the US market, where there are some differing attitudes towards alternative performance measures, but that is something that we'd expect to see clarity on before this comes into effect in 2027. As Ollie mentioned, there have been some wider updates to FRS 102 and UK GAAP, all of which seem to be moving UK GAAP to be more aligned with IFRS. So the first two changes up there on the screen are a new model of lease accounting based on IFRS 16. So this is taking the old FRS 102 and moving it towards IFRS 16, where leases will now be recognised on the balance sheet, not through the profit and loss. It essentially removes the ability to recognise operating leases in the income statement. The key thing here for people who haven't recognised leases under IFRS 16 before, it does cover all leases, so it's not just buildings. It is every lease that a company has. So it could be, for example, motor vehicles if you have leases for those. There are some practical expedients, so they're based on sort of lease size and lease length, which can mean that there are some leases that are or can still be recognised within the profit and loss, and there are some extra simplifications when comparing it against IFRS 16. So it is worth going through the detail and understanding that change. New revenue recognition policy based on IFRS 15. So for those in the room who are operators or B2C operators, it's less relevant based on the fact that that's already accounted for under IFRS 9. But where there are B2B businesses or affiliate businesses, this represents quite a significant change from the way that revenue recognition worked under old FRS 102, and it is a lot more based on IFRS 15. There have been various other incremental improvements and clarifications, which I'll come on to shortly. The next two slides are the detail behind the leases change. We've included that because there's quite a lot of information around transition and the updated recognition policy. I'm not going to go through that today, but that is included within the pack for you to read through at your leisure. Here are some of the other FRS 102 amendments. So as Ollie said, FRS 102 and the FRS 102 revised does represent quite a big shift in UK GAAP, and there are quite a lot of changes. I'm not going to go through all of these, but the ones that I would pick out particularly from this table would be financial instruments and the removal of the ability to start applying IAS 39. There's also been some guidance and some clarification in respect of business combinations. So some additional guidance around how companies recognise or determine who the accounting acquirer is in a business combination, moving that more in line with IFRS 3. And clarification on distinctions between contingent consideration and remuneration when thinking about acquisition. So how you calculate the consideration of an acquisition and whether parts of it could be more akin to remuneration rather than included in the consideration figure. The bottom row there, income taxes, is also quite a big change. So it does bring in accounting requirements that are similar to IFRIC 23, so uncertain tax provisions. I would expect that would lead to an increase in the amount of provisions being recognised on FRS 102 balance sheets as people have to provide for uncertain tax positions. We've included here some more information around the transition, but as I mentioned, almost all of the amendments come into play from the 1st of January 2026. That is a bit of a whistle-stop tour through accounting updates. I appreciate that there's a lot of information there, and I don't have loads of time. But like I said, that in the webinar, there is a lot more detail and a lot of practical examples of how each of those could become relevant for different businesses. And I will be around afterwards if anyone's got any questions around how that may impact them. I'll now move on to cover some messages that have been released by the FRC in 2024. So on the screen now are the top 5 and then second top 5 issues that have been identified by the FRC as part of their review of corporate reporting in 2023 and 2024. So these are issues that have been recognised when they've performed their review of a number of listed financial statements. Again, not going to go through these individually, but the thing that stands out to me is that the top 2 impairment of assets and cash flow statements have been in the top 5 the past 2 years and have been near the top of the list. So this is area of consistent challenge by the FRC, and it's something that I would expect them to be looking at and something that companies should be paying particular attention to when they're preparing their financial statements for 2024. The top 10 is also communicated obviously to all audit firms. So I would expect that your auditors in 2025, as they're looking at 2024 year ends, will be paying particular attention to the disclosures for all 10 of these in the financial statements. There have been a number of other FRC publications in 2024. So included within the slide deck are links to each of those. And again, these can be reviewed following the seminar today. And finally, I'd like to move on to talk about our final topic in this section, which is corporate governance changes. So as you can see on the slide, there have been some QCA changes in the current year, which came into effect in April 2024. And there have also been some changes to the UK governance, corporate governance code, which came into effect from the 1st of January 2025. That is with the exception of provision 29, which comes into effect from the 1st of January 2026, and it's probably the most significant. So provision 29 represents the most significant corporate governance change on the horizon. It brings in reporting requirements in respect of material internal controls. So as you can see from the white box on the screen, and for those of you who have been involved in US listed businesses in the past, it is very similar to that, or the criteria that are set out in SOX 404 compliance. The main difference being that unlike SOX 404, there is currently no mandate to have any external assurance obtained. So at the moment, you wouldn't need your auditors to also give you assurance over the internal control financial reporting environment. Whilst that isn't required, it still does and can represent quite a significant project when looking at companies' internal controls. And it essentially means that management are going to have to opine on the effectiveness of all of their material internal controls. So that's obviously quite a serious thing that people will need to be doing. So that does represent a very significant change to the UK Corporate Governance Code. And that does come into effect from 2026. So it's something that I would expect companies to be considering throughout 2025. So they're ready for when that does come into effect in 2026. So that was a bit of the top floor. I think I'm on time. You're looking at me nodding, so that must be a good thing. Like I said, I'm around today. I'll be here all day and I'll be at the lunch later. So if anyone's got any questions, then please feel free to reach out.
Right. I hope you're all anticipating this exciting session. Just kidding. My name is Vernie. I'm part of the Risk Advisory Services here at BDO. I specialize in AI and also have experience in data privacy and data protection. I've specialized in that for the last 20 years before it was sexy. So today we're going to talk a little bit about AI, but it does have a huge overlap with privacy regulation. So it's crucial for you to understand. So I'll cover a little bit of that. And then my colleague Louise will specifically cover the UK aspect of it and the regulatory focus here in the UK. Right. Before I go into the regulatory update, I just want to sort of perhaps spend a couple of minutes to talk about why this is really important for your sector. It is not to add, but you have an increasingly growing regulatory landscape as it is. This is another one, it's probably what everybody's thinking is another one that's coming through the thing. But it does carry great risk. So we're going to talk a little bit about that. So today, I hope at the end of this session, you're going to learn a little about this regulation, why it's important to your sector, and what risks this is going to bring in, and why we need to worry about it. So from my understanding, your sector is a prime land for AI. It lends itself really well, partly because of the amount of data you process, your operating model, and the global nature of the business means this regulation is a prime regulation for your sector. And, it brings about both opportunities as well as risks. So managing and balancing those things is really crucial to actually benefit from the benefits that the AI will bring. So what we've seen is AI is being actively used in this sector from 2000. AI is not new. It's been around for the last 18 years, but we're talking about it because the regulators are worried about the impact it has on consumers and our ability to explain that to the consumers in the way that we process the data. So that's what this is trying to regulate. And in the gambling and gaming, betting gaming sector, we've seen it over the last 5 years. It's used to sort of maintain single view of customers, to detect fraud, as well as to make the customer journey easier, which is the benefits. But there are cons that comes with it. That's why the regulation's here. And because you have been using it for the last 4 years, there are some aspect of compliance that's rapidly coming into place. It's particularly in February 2025 is a crucial deadline. I'll go through that in a minute. So today we're going to specifically look at the European Union's AI Act and the UK, just to understand the landscape, because most of you here will be touching those locations. There are other regs coming around the world. They're not finalized, but these are high-level benchmark that you could actually operate from in order to manage the risk. So the European Union's Act is a regulation. What it means is if you operate in any of the member states, it will apply equally right across the member states in the same way. So you have same level of protection. Your consumers have the same level of protection regardless of the country that you operate in. In addition to that, it has an extraterritorial application. What that means is even if you do not have an office or presence in EU, but if you're operating from outside, so digitally online, but you're serving the European citizens, you're caught by this regulation. So that's a crucial difference you have to really understand. It's really similar to GDPR. Basically, it's about safeguarding the rights of European citizens. So we follow the data in this regulation. And then the last one, which is perhaps not explicitly understood by many people right across, not just in this particular sector, in across all other sectors as well. So you could make a decision here in the UK using UK data to offer a particular product or services, or to benchmark where, say, for example, in the vulnerable customers, what the criteria for flagging those might be, and then use that data set to make decisions in Europe. So you're not actually processing European citizens' data, but using the statistics to make decisions in EU. The law will apply in that case as well. So it's really important to understand that. Now, the law came into place August 2024, so a few months ago, but it's sort of staggered over the next 3 years. And I'll come on to that in a minute, why they've taken that approach. So we have 3 years to fully come in, this law will come into place, but it is partially in place from today, like February, some of it will come into place. So you should really be on top of it. And I think in the sector that we're talking about, because you have been using AI for so long, there are systems could be quite intrusive. Some of those might be prohibited under the law. So it really is important to go back and do the homework to see, can we continue to operate the system that we have in place? That's why we're hoping that you're going to learn that from today and go away and think about it. And then in the UK perspective, we do not have a specific AI regulation. So AI here in the UK will be regulated or continue to be regulated for the time being from a UK GDPR perspective about processing personal data. I think we're kind of looking and see what EU is doing, and UK at this stage wants to appeal to new innovators, like it's a safe place, there's less red taping, come and produce lots of AI here. We're not going to monitor you like the EU. That's the approach. But I think over the next 2 to 3 years, we will go down the regulatory space in order to compete in the global market. So it is something that's coming through, and there's new updates and sort of white papers coming out of the government around AI in terms of not just embracing the technology, but to be seen to be a safe place to innovate and to process data, which is also important from a European perspective. You remember with Brexit, there were a lot of talks about, can we continue to operate in the way we did before Brexit? So that involves moving data. So after Brexit, there is an agreement between UK and the European government to ensure the free flow of data. So we have to continue to ensure that we provide similar level of safeguard here in the UK that equates to EU. Otherwise, we can't operate global structure. That means we do have to catch up at some stage with the European Union's regulation. So as you can see, when the Act come into place, so I've put down just really high level key dates. So prohibited systems, or systems that are very intrusive, that are now prohibited under the reg, will have to be decommissioned by February. That means you should already be in your compliance journey to evaluate what AI tools or systems you're using. Are they on that particular bucket or not? And at least get the ducks in a row, because decommissioning a product that you probably rolled out globally is cumbersome and it's not really easy to pull it down. So you might have to think about ways to perhaps reclassify it under high-risk systems. We'll come to that in a minute. So we can add safeguards to put a prohibited system into the high-risk category at some circumstances. It may not always be possible, but it is possible. That's where a lot of people are kind of looking to understand what systems they're using, what categories those systems fall under. So the AI Act is a product-specific regulation. So it means it's really not regulating the data that goes into it. It's regulating the way the system will process the data to make decisions. But the data aspect will continue to be regulated by the European GDPR as well as the UK GDPR here in the UK. And then 12 months later, we then have August of next year, we have some obligations for general purpose AI because it's mostly coming from the global perspective. So they are giving them time to bring it up to speed. And also we do not have a regulator yet around to govern this from a European perspective. So they're buying some time. So they put out the regulation, they're just getting the regulatory landscape in place. And the other third bucket that's really crucial is a high-risk system. So we have a couple of years to get into that space. But the reason they've given that time is it is probably the mostly highly regulated bucket. So they are giving the organizations time to get the processes in place to ensure you correctly classify them, and you're adding the compliance framework to ensure you're meeting the regulatory requirement. And as I said, because we do not have the regulators in place yet, they want to buy some time because they will have to audit. There are some assurance that the regulator also has to do in that particular bucket. So they're not there yet. We anticipate the privacy regulators in EU to be the regulator for AI Act, plus medical devices regulator from a device perspective, because it's a product-specific reg. And there's also assurance that the regulator performs in that particular bucket as well. Now, not to scare you, the fines are hefty. So if you get it wrong, it's 7%. There are some exceptions, but just at a high level, it's 7% global annual turnover. So you make a mistake in one country, that doesn't mean it limits it to 7. It could be multiple of 7. So obviously, if you have a global breach or you got something wrong in a global tool, you could get fined in the UK under the GDPR, which is 4%, UK GDPR. And in Europe, if the same system had been identified to be non-compliant in Europe, you'll have the 7% under the AI Act, plus the 4% under GDPR. Now, this is just the two regs. You now have China's got new regulations coming through and other countries also coming through in the AI space. And they're going to follow, most likely to be the EU AI Act bandwidth, which is what they've done with GDPR. So when you're looking at an opportunity an AI tool brings, you really have to assess it against the regulatory fines to make sure they're balanced and you're actually mitigating those risks quite carefully and getting the ducks in a row. Now, the AI reg fines and GDPR is one of the two fines. You could be sector-specific fines as well. There are ethical boundaries and other regulations that come into place about treating consumers fairly, for example. And to mention reputational damage and contractual fines as well. So if you've got a tool that you have developed because you've got data and you've taken it to market, and there are contractual liabilities that will come through. And because of the data that you're processing is global and large scale, consumers of certain groups can also come with class actions. So if you've not given a product or services to a particular group of individuals because you've decided they're not the right party to offer that particular products and services, they could come through, for example, through the discrimination route to say, women are not offered a particular product or services because historically the AI tool probably was trained on data that predominantly focused on men. So there's a lot of bandwidth to come into this financial sanctions. It's really important to square them all correctly when you're looking at an opportunity. So one of the things that we recommend here at BDO, and also I think it's quite generic, but it's really important to understand the journey. So already in your sector, I would have expected your organizations to know what AI tools you are using and what categories they are falling under, because you have been heavily using AI for some time. And if you don't know it, all of the other things will fall away. So you will not understand what regulations are caught, how they impact. You will not know the risk buckets you really have to worry about. And at this stage, given the fact some of the prohibitive systems are coming into play quite quickly, at the very least, you should really understand your current state of compliance. So that first bucket of prohibitive system should already be identified. You should be getting the ducks in a row and then kind of considering the high risk item. And then the other two really surround the assurance. So once you know the systems, once you know what the regulations are applying to those, and you know where you are, that allows you to decide what controls you can already piggyback from. So there will be privacy and security controls that you can leverage to offset some of these risks, where you need to make amendments around the controls to mitigate those risks, and where the new controls are coming, because the AI reg does have specific controls that you need to put in place as well. So you know those three buckets of controls, and you can work through that. And if in the event a regulator comes knocking or there's something goes wrong, you have a sort of route map to explain your journey, which will help a great deal in mitigating those fines we talked about. And then obviously working with the first line, the business, to implement those controls so that they are in place operating, and you can pick up those AI risks before they're even implemented. It's really crucial, because once they're there, it's really hard to mitigate those risks because the quantity of data you're using. And then obviously you've got the compliance testing, audit, internal, external audit and assurances come into place. And we always recommend follow the data, partly because the nature of your business means predominantly you are going to use individuals' data in order to make those decisions, or statistical data to make decisions about individuals. So follow the data, utilize privacy and security framework that you already got, so you're not reinventing the wheel, which is really important, and also to buy in internally and to manage funds around compliance management. That allows you to have a holistic view of risk management, both from privacy, security, and AI regs, and there's a massive overlap. The only time you'll have a delta that, if you follow the data, that might be missed is where the system is purely technical and there are no personal data. It'll still be caught by the AI Act, but it'll miss out from the privacy and security perspective because it won't be caught. And one other thing I wanted to say, a lot of people we've spoken to sort of rely on the DPO and the privacy impact assessments to run this through. The difficulty with that is too late in the chain to get the DPO involved, unless you have a really strong governance process that they are involved from ground zero. So conception of an idea or to conception of purchasing a tool, they should be in the room, you should be talking to them, and you should be telling the head of risk about those fines that you're going to worry about, because that feeds into your contractual space and third-party assurance quite heavily, because you want to make sure your contract is really sound in case the system is not designed effectively to mitigate bias discrimination in the output. So you can go back to the supplier and ask those questions. These are details of the 6 stages I talked about. I just didn't want to particularly put it on because I didn't want to read it. It'll be in the pack. You can read it in your own time. So usually the deliverables at the bottom is what we'll expect you to have in place as you move through the space, so that you can move through the compliance journey quite carefully and you can demonstrate that to the regulators. I've talked about all of these things. And one other thing I just wanted to highlight is this is a AI sort of current state assessment, maturity assessment that we have offered to a number of clients. You don't have to take this. You can make up your own. You can do one internally. You can create one as well. This is a very high level desktop assessment that allows you to understand the landscape of your current state of your AI maturity, to be able to decide where you need to focus. Do you need staffing? Do you have the SME? What kind of funding you need in order to get up to speed to manage that 7% risk I talked about, plus the GDPR risk. So I hope today that you'd be able to have learn something and have those conversations internally, to at least be aware whether you're using an AI tool or you're bringing something in to deliver something for your business. These risks are real and they're significant. They're not about to go from your sector. It is here to stay, because you're going to move more and more into that space and less likely to be working away from it. And I think the global nature of it is really crucial in order to have a global program, so that when you're implementing a tool that you can operate seamlessly within your operating model of your organization. It cannot be segregated in that you can't have a separate program for the UK and different parts of the world. You should have a single framework. So that means you can onboard tools that are widely available in the market in a seamless way. So that's my session, and Louise is going to cover the privacy aspect of it, because there is an overlap. So hopefully you learned something from that. Thank you so much. And I hope I kept to the time, Ollie. Thank you. I'm going to get a slap on the wrist later. Thank you.
Thank you, Vernie. Good morning, everyone. My name's Louise Sadler. I am a senior manager specialising in privacy and data protection services at BDO. I'm going to give you a bit of a data protection update, give you a bit of an indication of what the ICO is focusing on and some trends and enforcement action, a bit of an update on the data use and access bill, and then we'll go into some data protection specific challenges facing the industry as well. So just as a starting point, obviously the ICO is a supervisory authority. Each EU member state has one, and the ICO has a number of powers to issue enforcement action for non-compliance. We did some analysis to look at trends in enforcement action over the last 12 months and noted that the greatest kind of proportion, 46% of ICO enforcement action, was in relation to infringements in direct marketing. So particularly where organisations are contacting individuals, sending them marketing information, crucially without their consent. We've seen this across sectors, but we've also seen enforcement action in the betting and gaming industry. So I've just put on there a hyperlink to the enforcement action as well, which will be available to you in the pack. So Sky Betting and Gaming was issued enforcement action in September 2024. And this was due to cookies that were on the website and essentially individuals accessing the website. Their data was being sold to advertising technology organisations, and the individuals had no knowledge or consent that that was happening. So we are seeing enforcement action in the sector, and this is a real area of focus for the ICO. So just something to be aware of. Moving on to the data use and access bill. So in October 2024, the Labour government announced the Data Use and Access Bill. It's currently in the House of Lords in the report stage. And this is essentially the Labour government's take on reforming the UK GDPR after the previously failed Data Protection and Digital Information Bill under the previous government. The draft bill doesn't propose excuse me, too many drastic changes. It's not a significant departure from the UK GDPR. The reason for that is because the UK wants to retain adequacy status, so to ensure the free flow of personal data from the EU to the UK. What we're seeing is a few kind of tweaks around the edges, if you like. So clarifications around the proportionality of data searches in the context of subject access requests, expanding the definition of scientific research provisions, etc. I think my key takeaway for you for this is that if your organisation is broadly compliant with the requirements of the UK GDPR, when the draft bill does receive royal assent, it's going to be more kind of tweaks around the edges and adjustments to existing compliance rather than kind of the wholesale implementation that we saw back in 2018 when the GDPR was enshrined into UK law. So we'll wait to see how the bill takes shape over the coming months, and we'll of course be writing updates about this and publishing that via the website, so do keep watch of that. And then now, apologies, the writing's quite small, but I just thought it'd be helpful to run through some sector-specific data protection challenges. So firstly, international data transfers. Often we've got individuals kind of operating across multiple jurisdictions. You've got multiplayer online games, etc. And so really important to think about where that data is stored, which which countries it's going to, how data is being managed globally. It's really important to firstly have oversight of those data transfers, but also to think about the fact that back in 2018, we saw the GDPR as kind of the golden standard of data protection regulation. Since then, we're seeing countries enact similar pieces of legislation. So there are country-specific nuances to be aware of in the context of data transfers. Sensitive and special category data is important to be aware of as well. So I'll come on to children's data in just a moment, but certainly if there's personal data processed about vulnerable individuals, for example, health data constitutes special category data. So it's really important to have oversight of instances of processing special category data in order to ensure that the appropriate safeguards are in place. There are considerations regarding children and minors. So in the UK, under the UK GDPR, the age of a child is defined as 13. Unhelpfully, that age is different in different European countries, but really important to think about, the processing of children's data. I saw a stat that 93% of children are playing video games, and certainly the ICO has pushed out some guidance particularly for gaming developers in terms of how to comply with the children's code when developing games for children as well. Account integrity, sharing credentials, data security, all very important as well. Not only in terms of ensuring that personal data is held securely, but also sort of knowing who you're dealing with, particularly if kind of credentials are shared between individuals. Data protection by design and default. This is one of the principles of the UK GDPR, in that organisations are required to embed data protection considerations when implementing a new system or process. What does it mean? It means that your developers need to really become friends with your data protection and privacy teams to ensure that privacy risk is considered from the outset and key risks are mitigated on an ongoing basis. And then I think the final challenge for the industry is around individuals' rights. So certainly since 2018, individuals are a lot more aware of their rights in relation to how their data is processed. Organisations across sectors are seeing an increase in the number of subject access requests. And I guess the challenge for the industry is, how do we grant individuals their right to access in a really seamless and frictionless way? And that might, involve ensuring that we've got key processes that are defined, using automated tools where possible, and ensuring that there's sufficient resource to manage those requests, given the fluctuating volume, and also the 1 calendar month for granting rights requests as well. So again, very much a whistle-stop tour through the data protection update and considerations, but as I say, the data protection, the data use and access bill, and the Sky betting enforcement action is hyperlinked on the previous page for more information, and I'll be around during the break and at lunch if you have any questions. Great, thank you.
Morning all. Apologies for the slight switch up in order. As those I'm sure this room know, there's never a dull moment when you work in the client-facing roles. Sorry for the slight switch up. I'm Clorinda. I'm one of the directors in BDO's Economic Crime Advisory team. The bulk of my work focuses on regulatory compliance, both in the financial crime space, but also extending into social responsibility or responsible gambling, depending on which acronym is your preference to describe it. I just wanted to take a few moments today to talk to you in a bit of a look back, look forward kind of approach in terms of some of the key things that stood out to us in 2024, and also looking forward to 2025 and what we think are going to be some of the key things to be watching out for. So without further ado, I guess the first thing to mention is obviously the change in the UK government. We obviously introduced a new Labour government replacing the Conservatives over the summer. And the brilliant thing is that the Labour manifesto committed to reforming gambling regulations, strengthening protections, which obviously is a great thing for our industry. The government has committed to bringing in a few key changes, which is fantastic, that the Conservatives sort of suggested. So it's really good to see continued traction on those things. And the key bits I wanted to talk to were the levy and the slots stake limits. In terms of the levy, as it says on the slide, obviously the aim of this is to raise a load of money to help fund safer gambling prevention, safer gambling and harm prevention. And at the end of November of last year, Labour confirmed that they will actually be going ahead with introducing this. We're expecting it to be coming into force in April, with first payments being made in October of this year. The legislation is currently in draft, so obviously those timelines are subject to change, but that's what we're thinking at the moment. The levy is going to be charged on top of existing gambling duties and apply to both B2C and B2B operators. So this is a little bit of a new niche point, because a lot of the current gambling levies are just for B2C, so something for the B2B operators to look out for as well. And generally, it's being followed a polluter pays principle. So the GGY yields based on different casino products or gambling and betting products will determine how much is paid towards serving. Now, this is an interesting one from my perspective, because obviously this is all in the responsible gambling world, but actually it's not hugely dissimilar to the economic crime levy that's already in place. And that's applicable to betting and gaming operators who have a casino license, so possibly something not so new to a lot of the operators within this sector. Notwithstanding that, obviously it is another cost to factor in from an accounting perspective, and also just another standard to be compliant with. So something that should absolutely be on people's minds as we progress through this year. The other piece is the slot stakes limit. So again, at the back end of November, it was confirmed that this will go ahead. We were expecting it to go ahead a little bit earlier in September. September kind of came and went and nothing happened. And obviously we did have the change in government, so that was understandable. These slot limits will come into place at a slightly different limit depending on the age of the customer. So £5 for the older people, I say old people, above 25, which is obviously not older people, and £2 for considerably younger gambling customers. And we're expecting that to come in the near future. However, we don't have much detail around when that will be yet. So we're very much in the kind of watch this space territory. Moving on to enforcement, obviously a subject very close to the UK Gambling Commission's heart. So 2024 was a bit of a bizarre year, to be honest, in comparison to 2023 and 2022. We only saw 2 settlements relating to AML and social responsibility throughout that year, compared to about 14 or 15 the year before. So it was a bit of a different time for us. Obviously, that also had an effect on how much funds were raised through those settlements. And you can see the figures on the slide. There's quite a stark difference. Obviously, this year, we've already seen one. We're only 16 days into January, so we've already had one settlement of about £1 million last week. So it's interesting to see that the year has kind of kicked off in a bit of a different way to how it did last year. So there definitely remains a question for me as to our standards really raising, or was 2024 just a bit of a slow year of competing priorities and a lot of change with other things going on? So I think that'll be remain to see throughout the course of 2025. And then finally, I couldn't talk about 2024 without talking about financial vulnerability checks. So here, looking specifically at the responsible gambling part of what my work consists of. The frictionless financial light touch checks were brought in August at a threshold of £500 net deposit per month. They are going to drop to £150, so something for operators to be aware of as of back end of next month. There'll be a reduction in that threshold. From our work, it's been quite interesting to see how this has landed in the sector. I'd say a lot of the larger operators that I work with kind of go, yeah, we were already doing something along those lines. So actually having the threshold set at £500 for now and then £150 going forward is a positive thing because it brings standardisation across the sector. However, in a lot of the smaller operators that I work with, This has been a bit more challenging because it's something completely new. It's not aligned to what they've been doing previously, and they're really having to update their systems and controls in order to be compliant. So it's been a bit of an interesting year, depending on the size and maturity of the operators for this one. But obviously, something else that the UK Gambling Commission is likely to be focusing on, given that it's new. So operators really need to make sure that they're being compliant with this. The one question mark that we have outstanding, and I'll touch upon this in my next slide in more detail, is what happens next. What we're not seeing at the moment from the Gambling Commission is, okay, you do this check at this threshold and it comes back that you've got a client who's got a bad credit rating or a couple of CCJs or whatever it may be, then so we're hoping in 2025 that we're going to see a little bit more from the Commission in terms of guidance, not necessarily 100% prescriptive, but just a little bit more in terms of what could be appropriate off the back of certain outcomes of those checks. So moving on to 2025 and kind of my whistle-stop tour, getting my crystal ball out to some extent and thinking about what could be coming down the track for the next years. I just wanted to touch on a couple of key points that are certainly on my radar, and these are by no means exhaustive. I want to start with financial risk, so the sort of dark grey shape towards the sort of 10 o'clock on that strange diagram. In terms of financial risk assessments, now obviously I mentioned there's a big question mark around what happens next to the light touch financial vulnerability checks. So once a customer has been identified as having some potential issues, what should operators do next? So we're hoping to see a bit more guidance in that area. But also alongside that, we mustn't forget that the UK Gambling Commission is currently piloting its frictionless financial risk assessments using various data available to credit risk agencies to determine what's useful, what's not useful for this particular sector. Now, that pilot we're expecting to end in the next couple of months. So I'd hope that we're going to see outputs from that going into the spring, maybe the summertime. And the aim of these is to really understand what the challenges are for those really, really high problem gamblers, the people who are able to deposit huge amounts over short spaces of time with minimal checks. Now, the Gambling Commission have said that a really key factor of this is they have to be frictionless. They're not intended to be a cap on gambling in any way, and they certainly won't affect a particular customer's risk score. But it remains to be seen as to how the pilot is going. Obviously, it's happening behind closed doors, and what the impacts will be, and subsequently what expectations will come out to be put onto operators to implement. So definitely watching this space on that one. Moving around to the little orange bubble and talking about the black market. So in September of last year, I'm not sure if anyone in this room read it, there was a really interesting article published by Frontier Economics. It was actually quite terrifying. It has some really horrible statistics in it. And I'm going to read from my paper to make sure that I don't get it wrong. So 1.5 million Brits stake up to £4.3 billion per year on the gambling black market. That's nuts. That's really, really terrifying. And these sites are obviously unsafe, they're unregulated, but unfortunately they are growing. They typically tend to deploy really aggressive advertising techniques to your younger market, to your people who have already got gambling problems, including those that are self-excluded. And they often allow things which regulated operators don't. So, for example, gambling with credit cards, use of VPNs, cryptocurrency, all of that kind of stuff. And what we're seeing is that some punters are actively seeking these sites out because they offer better returns, they offer better odds, that kind of thing. But actually, a lot of consumers are just being duped because these sites are really, really sophisticated and they look like regulated operator sites. And so that's quite terrifying. It's almost sort of venturing into the fraud world. So that's certainly something that's on our radar for the coming year, and probably significantly further on in terms of how does fraud fit into what we're doing now. And this is really pertinent, especially given the current economic climate. You know, obviously, the economy is tough at the moment. We're in winter. People may be struggling, especially if they're already facing gambling problems, to put the heating on, put food on the table. Those individuals who are really vulnerable might be turning to these sites and ending up in even worse conditions. In terms of what the solution is, it's a little bit difficult to say. There's a lot of noise in the sector that just giving the Commission more powers to enforce isn't really 100% the right answer. We've seen in other sectors that putting more onerous regulations kind of tends to drive people away from the regulated sector and into unregulated parts of the sector. So financial services is a really good example of this. So I think I'd like to see a lot more learning of lessons from the Gambling Commission. So looking at other mature regulators like the Financial Conduct Authority and seeing where parallels can be drawn to kind of tackle it ahead of the curve rather than waiting for the problems to have happened. Moving on to number 3, interaction. So the sort of light grey shape on the side there. The remote customer interaction guidance came into force on 31st of October 2023, so almost 18 months ago now. And something that we've noticed since that has been around flagging things in a timely manner, taking action in a timely manner. There's a lot of emphasis on timely manner from the UK Gambling Commission. We're hearing from a lot of the work that we do that the expectation is really, really high in the sector. So one particular operator said to us, you know, if an alert triggers at 3 o'clock in the morning because somebody is playing at that point, it's not acceptable to wait until 9 o'clock in the morning when an analyst might log on and triage that and look into it. That 6-hour gap, especially if that individual has already exhibited markers of harm, isn't going to fly with the Gambling Commission. So there's a big push towards how do we implement real-time action off the back of red flags being identified. Obviously, this is just talking in the online side of the sector, but actually similar pressures are being felt in the retail side as well, in the shop. So another separate operator that we were talking to kind of said that what they're looking into is use of iPads and video conferences basically in stores. So if a particular shop member identifies a particular person who they think is exhibiting markers of harm, they can go and sit in the back room with them on an iPad, on like a FaceTime, with a social responsibility and safer gambling specialist to really intercept live, rather than waiting for that individual to kind of stop and just checking, are you okay? Because obviously 90% of the time that individual will say, yes, I'm fine, and continue. So really interesting stuff being seen in that space, and expecting more, probably not necessarily more guidance. I think that everyone's scarred from the guidance from 18 months ago, but hopefully more lessons learned from settlements, from UK Gambling Commission publications on this topic in this year. And then final 3, I'll skip over probably the last 2 fairly quickly because we've spoken to them already, but just looking at that point around the Ombudsman, so something that the white paper called out probably 18 months ago was the potential for introduction of an Ombudsman. And this is all around customer complaints, and it would be applicable to both retail as well as online side of the sector. We haven't heard anything further than that. It kind of got put out there in the paper and then it went into a bit of an abyss. Which is interesting. And I don't have sight over whether that's still coming or even being tabled and suggested. But I don't necessarily think it's a bad idea. But going forwards, there's a lot of questions that need to be answered were it to be implemented. So a few of the key questions I'd have would be, what's the remit of it, obviously, as the starting points. But in terms of who could refer a case to the Ombudsman, would it have to be the customer themselves? Could it be the solicitor acting on behalf of a customer? Or could it just be a concerned relative or family member who's seeing the effects firsthand of problem gambling on their family member or close friend? Would there be a time limit? So at 3 months, 6 months, 1 year, what happens if I decided that I'm now really affected by something that happened 10 years ago? Could I then still raise a case to the Ombudsman? There's some questions outstanding in terms of time limits. There's also a really big question around, okay, well, when the Ombudsman provides their conclusion, what happens next? How are we enforcing that actually the outcome indicated by the Ombudsman actually takes place? Will that be the UK Gambling Commission's job? Will that be an Ombudsman job? How is that going to happen? And resultantly, how are we going to manage to make sure that the Ombudsman is completely impartial? So it will be interesting to see in 2025 if there's any further discourse that happens around implementation of an Ombudsman and how that will take shape going forwards. Penultimately, looking at slot stake limits, I already mentioned previously that these are being introduced, which is absolutely fantastic news. Obviously, protection of vulnerable customers, particularly with customers having that slightly different threshold to over 25-year-old customers, is brilliant. But given that the regulation is still being debated in Parliament, we don't really have a timescale yet as to when that's going to be introduced. So hoping, fingers crossed, that that's going to be something that is introduced this year, and we're going to have some clear parameters around it. And then finally, looking at enforcement, I'm not going to repeat all the statistics I said earlier. We've obviously now had a settlement this year already. Something that I picked out that I found particularly interesting, that there's a lot of focus on the operator not fully implementing its own procedures or its own policies, and not always undertaking processes and controls in a consistent manner. And that's a slightly different rhetoric to what the UK Gambling Commission's been saying previously. So I'd be interested to see in any future settlements that are published, are those kind of themes going to be becoming a bit of a trend for 2025 in terms of breach of own procedure or inconsistent application of controls? And then finally on enforcement, during the last sort of 10 minutes or so, I've only scratched the surface on some of the new aspects of regulation that were brought in across 2024 and 2025. There's lots and lots more that I've just not had time to speak about today. Things like direct marketing preferences, which are coming in pretty soon, personal management license conditions, B2B remote technical standards, all sorts of new pieces that are coming into force. So there remains an awful lot for operators to have to contend with in the reg compliance space, and certainly remains a tricky environment. That was a bit of a whistle-stop tour. Thank you for listening to me. The deck and everything will obviously be circulated, and my contact details are on there, so please do pick up with me afterwards if anything piques your interest.
So we will keep it short and punchy, or as much as we can, and we will hang around during the break and hopefully pick up the deltas there. That works. Okay. So welcome. Evan Rothenberg, I don't think maybe I don't have to be you, maybe a bit less, but I'm a partner here in digital. When you think digital, think all things IT, all things technology, anywhere from hands-on keyboard, cyber, you name it, to controls. To keep with the theme of today, I lead our practice with all third-party assurance and certification. So in Ernie's thing, the assurance bucket at the end. If you're entering a new market, what you have to do to make the regulators happy and your customers happy. That's my neck of the woods.
And Francis Yates, similar to Evan, very much around controls and the bank side and the assurance side of things. Working outside of that digital bit on the other side in terms of the sort of business process and controls, not dissimilar to what Clarinda was talking about, and Vernie in terms of embedding those controls, but then very much integrated with Evan and digital. Hence the double act.
There we go. Okay, let's see if I'm loud enough. I guess my American accent usually is, and it usually is too loud, but let's try this game. Yeah, but I usually don't need it, and I usually walk around. Okay, there are a lot of acronyms. I think we spent the last 2 hours talking about acronyms. Some of the ones you see, at least in the gaming sector from technology, is your 3402s are essentially if you are part of your customer's revenue cycle, they're going to ask you for reports. Right? And I'm not going to go into all of these. Just know there are some famous acronyms or reports that you or somebody in your organization will be asked for. Your SOC 2s, which is an IT security type of one. And then we do your UKGC RTS security audits. I'll walk you through the gaming trends and how these are evolving over the past year, and we expect it to. But just know there's a lot of reports, and like all these regulations coming in, you're going to be asked for an independent audit to do things. And the cost compliance is going up. So at the very end, I'll walk you through how people are trying to lower the cost of compliance, which is somewhat different than all the regulatory fines and all the topic we've had. Okay. The other bit to know, and this was intended more of a foundational, is that assurance and certifications, think of it this way. Assurance, which is why there's an audit practice professional service firm, is typically an inch wide and a mile deep. You go far more random sampling and all these things in the audit world, it gets a reputation. Certifications, and there's a whole bunch of ISOs and other ones, are mile wide, but an inch deep. Well, inquiry Tesla 1. So the rigor and effort to get ready for these things, although the subject matter overlaps, there's kind of two tranches of it. Okay. right? What I would say, and this is where I would say maybe it's better to have individual conversations to how it impacts your organizations, is that although there are a lot of acronyms and a lot of reports, and Francis and I were talking this morning, when you boil the whole thing down, and I will dumb it down and simplify it, new user provisioning, or if you add a user, get it approved, isn't every one of them. So like there's a significant overlap, even though you might have to issue a lot of reports or have a lot of these. If you boil it down to the controls, there's a common set of controls. And that makes at least how mature businesses who have lots of these obligations kind of simplify it and be successful.
So deploy it once, test it once, but apply it to multiple different requirements.
Test once, use many. Perfect. What organizations do as they go global and as they have different products and services. So if you're UK domestic and you have one solution, maybe it's not, but as it gets bigger and bigger and bigger, where most of you play, or many of you play, you try to map out your 5 years. So if you're entering the US, there's certain things you have to do. If you're entering other countries, certain things you have to do. If you're in that hybrid media, betting, gaming state, there's certain things you have to do. Again, from a controls, it's all the same control, but just different reporting obligations, right? So most companies will look out 5 years and figure out where the business is moving, map it back to the obligations, and then we help them with it is figure out what are these 60 controls that have to be tested, right? And that's how cost and compliance goes somewhat down, but up. Efficiency. With regarding the betting and gaming sector, there are some that we're seeing, I would say almost daily, but there's some that we're seeing more often than not. As I kind of mentioned, the area of the UKGC audit or the RTS audits that we do a lot of is the security audit. And there's some obligations for the UKGC, but the security audit is one of them. Anecdotally, not to get myself into trouble or any of my clients, they don't always ask for this audit, but you're required to do it nonetheless. And it should be done every year, but not always done every year. And I'm going to leave it at that. Anecdotally, the UKGC is asking for it now, or at least highlighting that you're supposed to be doing it. And there was an update to it in September 24, so recently, which allowed for other of those acronym certifications to count instead of it, or in like the ISO. If you do the ISO, you can then act 27001, the information security one. There's a way that actually can fit the bar for the UKGC security audit. So I say, if there's any questions on how that update impacted you to hopefully save time and effort, please come find me. I can walk you through it. These are savings type of things, or other test once, use many. They also, I said, they're more interested this past year. You always are supposed to give it to the UKGC upon asking. They've lowered it down to 7 days. As I said, they never really asked for it anecdotally, or they often didn't ask for it. Now they're setting a principle you actually have to do it. Okay. The other bit kind of fall part and parcel, and they go into building that 5-year roadmap, right? So if you, and these will be acronyms, and I recognize many of them won't mean much to you, so I will keep it high level. But if you enter the US and you have large global B2Bs, or you support operators, whether you do odds or platforms or technology or whatever it might be, exchanges, in that B2B, it moves towards that assurance in that first slide, which is like your SOC 2, which is an assurance report over information security. In Europe, if all of your operators and stakeholders are either small or European based, often that ISO certification still works. So as you're building that map, it's interesting to look at which areas and territories you go to and how it plays out. Again, we help clients, so just pick up the phone. Happy to tell you, okay, you actually need these 5. Here's why. It's a bit of a way to do it. And the other base, and I heard, Ollie this morning was talking about entering markets. If you go to Africa, or if you have multiple operators using your platform, if you support your client's revenue, there's probably a SOC 1 or a 3402 report that will save you. You just give it to everybody, save you time. So that's the third. So in the short and punchy, there's a way to cost optimize. There's a way to save your people time. If you ever hear your business and your people say, I answer the same question 10 times this week, can we please stop the pain? There's a way to build it so the pain stops. And I'm more than happy to talk to anybody about how it's built. There's a way and a madness to it.
Method in the madness.
There you go.
in terms of a sort of segue from the IT assurance piece, we also support within RAS and our controls capability with the implementation. So starting with a blank sheet of paper, helping organizations understand their processes, identify gaps, and then deploy and implement controls, as well as at the other end, doing the testing and the assurance piece. There's three main areas where we do that around US SOX, Provision 29, or control transformation, responding to some sort of burning platform within the organization. In terms of US SOX, that can be for a new IPO, so starting from scratch, or an IPO 2-3 years out. An existing US listed organization that's acquiring a UK or European entity that needs to get up to a sort of SOX bar, or just the UK sub of a US listed organization. The UK Corporate Governance Code, and I'll talk more about this later. There is a bit of moving parts around that, and appreciate there's been a sort of roller coaster of is it happening, it's not happening, it's happening. So hopefully bring some clarity to that, where there is absolutely some fatigue, I think, and boards and C-suites around what actually is happening, and the change in government, I think, and the King's speech has brought some more clarity to that. And the last piece around controls transformations, and that kind of goes to the points that Louise and Bernie were making earlier around deploying controls where there's a need for where there's a new regulation or responding to something operationally. So not only for a regulatory need or some kind of burning platform where there's an issue within the business and the systems and controls needs improving. All of that has a similar skill set, and we have a large team with a quite a sophisticated capability that can help clients of all sizes. The bits down the bottom are just those sort of services that we offer, and there's a real consistency around the governance oversight, hoping with project management and those sort of gap assessments. And we work really closely hand in hand with management to do that. And that can turn out to be quite a cost-effective way, rather than sort of building up a large internal team, having those resources with a sort of tap on, tap off to deliver those some of the more complex projects and some of that bigger heavy lifting stuff when you're deploying large control frameworks. The design and then the implementation piece, we have a sort of offshoring model as well, which helps with reducing cost of that. And then obviously the testing, and then linking in with our other SMEs such as Evan on any of the systems or SOC reports we need. So just I think I've covered that. Conscious of the comfort break looming large. So just to get up to speed on Provision 29, that's what they're calling UK SOX. And what that effectively all means is UK organisations are going to be required that report under the Corporate Governance Code to make a declaration around controls. And that's going to mean which controls they have in place in terms of the scoping, the methodology for arriving at material controls, and an assessment of those controls, and a declaration of those controls that are ineffective and what the company's doing about them. That is quite a large change. There is already a provision in the current Corporate Governance Code which says organisations and the board have to implement and monitor controls, but they don't have to perform that assessment. And so there's actually quite a large gap that a lot of organisations are working their way through. That there was a initial regulation that the government was going to release 2 years ago to make this in law. They pulled that regulation last year. However, the FRC have implemented the same legislation effectively through the updated Corporate Governance Code that was released this time last year, and that is the updated Provision 29. There are some other changes to the Corporate Governance Code around culture, but the big one in terms of the material impact that a lot of organisations are grappling with and needing to resource, because there often isn't the capacity or the skill set within the organisation to do it, is this Provision 29 piece, which will go live for year end starting 1st of January 26 and beyond. The interesting point around how that interplays with the King's speech, which was a few months ago, which was a bit of a surprise and inclusion, given the last government had dropped it, was around a draft audit and reform bill that's currently being worked on, and that will likely change the FRC into ARGA. That will give, with that change, will be more resources and a lot of more regulatory teeth to sanction and enforce the code. So expect a lot more scrutiny around the implementation of the code when that bill lands. I think if you skip to the next slide, the other big piece will be around the definition of a PI. So who does the code apply to? At the moment, it says premium listed, but premium listed doesn't exist anymore because the FCA has changed premium listing to commercial companies, equity shares in brackets. So there's a bit of confusion around exactly who the code applies to, notwithstanding the change to the PI definition, which will likely bring in a range of non-listed organisations that has been previously muted a definition of £750 million revenue and 750 employees to as a sort of threshold for you're now a PI. You now need to apply the corporate governance code. You now need to declare under provision 29 your controls and effectiveness. So there's a few different moving parts on exactly what this audit reform bill will mean for provision 29 and also for some other audit reform things. But I think we've got probably audit partners in the room know more about that than me.
Great question for Ollie to pick up as well. But to what extent is this attestation by management? To what extent are auditors expected to informally make sure that that attestation is done properly? Because in the US paradigm, if there's a 404A attestation and the auditor doesn't really think it's been done properly, then they just won't sign it.
So I think it's interesting, isn't it? Because the SEC or the PCOB originally had sort of three different outputs. There was management's opinion, and then there was the auditor's opinion of management's opinion, and then there was the auditor's opinion, and that then changed to just management's opinion for A and the auditor's opinion for B. None of that is in the corporate governance code. So there's nothing that's saying there needs to be an independent assurance of that control framework. Having said that, the external auditor has a responsibility at the moment to give an opinion in the front half of the report where this declaration is going to be. And so there's going to be an interesting evolution of audit approach, I think, around what is enough, what's written in that disclosure. And you may end up in a place where if an external auditor is not taking a controls-based audit approach, but there's management saying in the front half of the report, all our controls are working, it's fine, you're going to end up in quite an interesting conversation. So I think auditors are grappling with that. I think if you can see how auditors have approached the likes of GDPR or CSRD, I think that gives you an indication that it's very much a bit of sort of working with management, various stakeholders. If you go back to the heart of this regulation, it's all about how do you limit those sort of big frauds, the Carillions, that have a big impact on society more broadly. So the point of this legislation is around addressing a wide group of stakeholders, not only investors. And SOX is only about investors. It's just capital structure. So it's going to be an interesting one. And I think Ollie's probably having lots of conversations, and I'm sure the audit technical teams in all firms are working overtime to kind of develop an approach on this.
It is going to be a challenge, I think, because one of the responsibilities of the auditors is to report to management any significant deficiencies, control failures. And so if you're reporting that as an audit team to the audit committee, but then the business is saying that they're giving themselves a clean bill of health, the two just don't correlate. And it goes to the point there around what then goes in the audit report, where we have to say the annual report is consistent with what we know, what we've read, etc. So I think it is there's going to be a few challenges, I think, and a few challenging discussions, I suspect, over the next couple of years as these things start to play through. But it's a pertinent point. It's a really good question as well. So good.
Thanks, Dave.
Yeah, we're very fortunate to be joined by David from Pure Capital and Ivor, who's joining us from PL Hunt as well. And then we have Ollie Woodward, who's from our corporate finance team here. We just wanted to, as I say, just sort of take a bit of time, really. Firstly, just a little bit, just to reflect on some of the sort of deals and transactions in the sector in the year. It's obviously always a very active space. So a bit of sort of bit just to look at on sort of deals and themes from the year, and then certainly just a bit, and then hopefully wanted to progress from there, just a bit of a look forward towards 2025, touch on a bit around sort of capital markets, public markets, what we might see there, and just anything else to see coming down the track into 2025. So I mean, Ollie, maybe you want to start first, just give us your reflections on 24 and themes and stuff, really.
Yeah, thank you. So, I mean, the backdrop to 2024, there's no doubt that it's still a macroeconomic level, that it does remain tough out there. But I think that as has always been the case with the gaming industry, a lot of activity. And actually, since COVID, it was the largest, it was the most active year in terms of deal volume, deal size. We actually saw a return to a lot of the kind of 1 billion plus size deals, and I'm sure we'll touch on a few of those when we're going through. But maybe if we start with Flutter, because they're almost the ideal case study as to what's going on at the moment, in my opinion. There was the sort of delisting from the UK stock exchange, and they are now listed in New York. And obviously that is a move for a business that has now also moved in the process of moving its headquarters to New York from Ireland. They're really trying to establish themselves as a global business. That's how they see themselves. They structure themselves regionally, and the way they're supplementing that is through M&A. And in the year, I think two of the most significant transactions. One was their acquisition of Snai from Playtech. That was just a very pure example of a big market player looking to shore up sort of market share and dominant position in a market through M&A. And then more recently, and we'll probably touch on Brazil quite a bit, they acquired NSX, sort of Bet Nacional business, for nearly $500 million. And that was probably the first big Brazilian M&A move of that size. And the multiple on that deal was actually 18, which was really significant. And it probably is a sign of things to come. And there is this intrinsic link in Brazil of being actually enshrined in law that you need to be partnered up with a local player. And so there is obviously M&A is an obvious way to get in there and do that. So that Flutter, very interesting year around those areas. And I think the other aspect that was really interesting for me is this dynamic between what's going on in the US and European operators. So I think going a couple of years back, we saw sort of BetMGM through Leo Vegas sort of coming into the market in Europe, and they also acquired Push Gaming. And what this is all kind of centered around is these sort of legacy land-based operators in the US doing their best to challenge the juggernaut that is the sort of legacy fantasy operators in DraftKings and FanDuel. And we're seeing a lot of that M&A activity is those land-based US operators looking over for European expertise to compete, to supercharge their businesses. And some other examples of that in the year was Leo Vegas also acquiring Tipico's US assets. And I think there was also a deal involved with Caesars have been acquisitive as well, and Hard Rock. So there's this dynamic going on where, whilst everything going on in the US can sometimes seem quite far away, there's still very much this trend of dipping into the European market to get that expertise, whether that's product, B2B, even management, because they've got that long-term experience. And I think we're going to see that continue.
David?
Sure. Thanks, Ollie and Ollie. My reflections on where we've been, I'd almost go back on a sort of five-year view. Obviously, the start of COVID changed everything. 2021 was really a peak year for M&A, easy money, high share prices. from mid 22 until the end of 23, things were very difficult with increases of cost of capital, falling share prices, much less confidence, and so I'd describe with that kind of up and down background, that 2024 was almost a return to a mid-level environment for M&A, which I would say we are still in, and one can never predict what might happen and what might throw us into a hot period or a cold period. But at this stage, at the turn of the year, then it is a in my experience, it's a reasonably benign period where reasonable sellers and reasonable buyers are finding that their pricing expectations are close together. 22, 23, one had the problem of, well, my competitor sold for this much in 2021, therefore I'm not going to go anywhere near where your renewed price expectations are. So, from our perspective and then things we're seeing, it's positive. I think one theme of last year was lots of people taking a long look at Brazil, and it's interesting that really Flutter's deal was pretty much the only one that got over the line, and principally because I think ultimately the way local brands have been running their business was very different to how they would need to run them post regulation, and buyers just couldn't get comfortable with is this thing going to be worth what we would have to pay for it now in the middle of 25. So I think that will come back. That activity is taking a pause now, and it will come back from mid-year when people can really see how these targets have coped with the regulated environment.
Yeah, no, I think Brazil is going to be as I said earlier, just an interesting, very very interesting one to watch, really. So, either just maybe from a capital markets, public markets perspective, just maybe some sort of reflections on 24, and then maybe just sort of from that take us through to 25 and what we see coming through there.
I thought those were excellent reflections from my fellow panelists. I wish I'd been writing those things down.
I was just copying them from your notes.
Consolidation must be coming to an end, right? Just the maths of it. After years and years, there just are fewer companies, and significantly fewer companies being developed. The thought on my mind, perhaps tying 24 together, that I think might continue, is clearly by and large, the biggest share of companies' budgets is in marketing, is in catching eyeballs, is in getting traffic. And I thought there were a couple of other strategic themes during last year that might continue. Among the diminishing affiliate space, there were a number of significant transactions trying to climb onto the remaining dry land in that space. Better Collective share price is down about 57% over the course of the last year. So maybe it's not great being an affiliate in Europe. Gambling.com up about 52%. So probably tells you where you want to be trying to grow that business. So I think there might be more consolidation in that aspect of catching eyeballs. And just looking slightly beyond the boundaries of the sector as we typically talk about it, I thought there were two really interesting deals. Firstly, DAZN buying Foxtel in Australia, or combining with Foxtel and News International, getting a stake. And anybody who's been around a long time, you get a little bit of a ringing bell that thinks that sounds a bit like Sky Bet, that combination of highly qualified traffic to sports video content, along with a business that could get involved in sports gambling. And then Fubo and Disney and Hulu merging their live streaming platforms, and then there's Disney and there's ESPN, isn't there? And Fox Bet didn't work out so well with Flutter, but you can't imagine they're going to leave alone that opportunity to combine that traffic driver along with monetization through gambling. So I think that continues that theme of how do you widen the funnel more cheaply. And then the third theme, I think most obviously, was in the lottery space, where DraftKings bought Jackpocket and FDJ and Kindred, one bought the other, or they merged. And you wonder what the UK lottery under a different ownership might do, because you had Flutter already buying Sisal, a big lottery operator, and talking explicitly about the value of the top of the funnel in lottery. So where you're spending most money is marketing. You're going to try and find ways to optimize that marketing transition, I think. Public markets. I'm the public market guy on this panel, I suppose, although David, we've worked together, so I know you have the same expertise. Peel Hunt has an IPO speedometer into which we make many inputs to determine what the likelihood of IPOs in London is. We're currently traveling at 27 miles per hour, we think, and the market is selectively open. So we have a handful of IPO transactions on the road, but it's much down on peak periods. I think the public market matters as a source of capital, for an alternative source of equity capital for companies, and a source of information about the industry. This is the UK is the third largest pension market in the world. 15, 20 years ago, 40% of pension assets were held in UK equities. It's now 4%. That's a £1 trillion outflow from the UK equity market in a £2.5 trillion market. So if you ever wonder why the UK is not performing as well as the US, that's a very significant factor, along with us continuing to charge stamp duty and the like. And for companies to enter the market, there were 160 companies in the FTSE small cap index in 2018, and now there are 102, and the value is halved to 25 billion in total. So I hope we're grounding on the bottom and heading towards a recovery. And the key driver for valuation in public markets is bond yields, and they are bouncing along the top, we hope, and will drift down, and then demand for equities will naturally pick up. So there are listed companies still in the UK and in other markets. They have access to equity capital, but it's relatively expensive, and I think it's putting something of a cap on M&A transactions and companies coming to the market.
I mean, the percentage of pensions, I mean, I saw that stat last Sunday as well. So I couldn't believe how small a figure that was from a pensions perspective, which, you know, does think that actually the government needs to do something there, and ditto the stamp duty piece as well. I think we're only one of a few countries in the world that has any stamp duty on that trading there. So that's clearly not going to help things really. And the consolidation piece as well, I think it's interesting actually, because I said earlier, we do the EGR Power 50 each year. And if you look at how that was probably 10, 12 years ago, how many companies you had, and how, you know, you almost struggle to get to 50 now in some degree, because you've had so much consolidation in that space. And I think you're right. When does it stop? I think we're probably seeing the second or third wave of, you know, we're certainly seeing quite a lot of B2B activity. And I don't, Ollie, is there anything you're seeing there specifically on the B2B side, or where you see the trends on that tool?
Yeah, and I think on that consolidation piece, there is still a feeling that in certainly regulated Europe, if you're able to establish a market share of sorts, or you have a strong brand, you are going to be the target of M&A, particularly from those large conglomerates, large scale brands. And I think very recently Novibet was acquired by Allwyn, which is quite an interesting one, given Allwyn's historically a lottery business, and it's a way for them to diversify. And that's a good example of that. There is still some fragmentation in other areas of Europe, like Eastern Europe. So that's where maybe you'll see a bit more of that sort of M&A of faster growing newer businesses. But yeah, so it's certainly an interesting dynamic. On the B2B side, still very active. You know, there are a lot of B2B businesses that, whilst what we've seen in the past is operators are keen to bring technology in-house because it gives them more control, it increases their margins. There are a lot of B2B businesses that are just grown to the size that they're almost unattainable in terms of acquisitions. Thinking of the likes of, you know, Pragmatic Play and businesses like that. But what we're also seeing on B2B, which has been a trend for many years now, but there were some really significant deals this year, was private equity interest in B2B. It's obviously that one step removed from the regulation, and probably the most high profile of those was Every's acquisition of IGT's gaming business, B2B business, I think for about 6 billion, was one of the most significant deals in the year. So we're still seeing that B2B and private equity linkage. And It's not without its challenges, and I think whilst I can't disclose a lot of them, I think a lot of the deals that we've been involved with that have fallen away for one reason or another have been in that B2B space. And that's really about finding that right profile between either operator or B2Bs buying B2Bs. So it's not without its challenges.
Just sticking on that private equity point, I mean, you mentioned that sort of every IGT deal, which was had Apollo behind it as well. And I think we've seen Apollo popping up on a few of the large transactions, some of the Italian assets as well, when they were looking to SBS were offloading, and I think probably even the SNI deal as well. I think Apollo has some interest in that. But I don't know, David, if that's something you're seeing, or if you've got a view on sort of more private equity money coming into the space still.
We do see private equity interest. I mean, we have seen private equity interest in the sector for quite a while, but it is only really a small handful of private equity houses who ultimately get comfortable with the sector. So generally, if we're running sell side processes, when we're running sell side processes, the private equity angle is rarely our highest expectation for an outcome, and the Apollos of the world and CVCs are looking very much at the higher end, only at fully locally regulated or fully regulated B2B or B2C. So it is they have a narrower target list in their site than trade buyers, for instance. So and I don't think that is going to change significantly. They also have a lower risk appetite generally. If the DD says, well, this thing might come under pressure from unregulated operators, et cetera, then they are more likely to walk away than trade buyers. I think where they're more likely to be active is tuck-in deals or bolt-on deals onto things they've already got. But it's not this. I don't believe this sector ever will be a sort of, standard PE kind of hunting ground. To touch on the question of, is consolidation almost done? I remember sitting down with a very, very experienced sector-focused legal partner in 2012 who told me that consolidation is done. We want to do more things in payments and adjacent sectors, because this was in the wake of the BWin Party merger and things like this. And I thought, I really don't think it's done. But anyway, I'm not going to argue with you. So the sense that it's coming to an end is undoubtedly, in my mind, false. I think the way in this sector, just in the last 2 or 3 years, where you've seen the real growth come from is businesses, so things like sweepstakes businesses, some of the crypto-focused operators, seems to be run, out of quite a few out of Australia, places like that. So things like, Huddle, Sleeper, Stake, Rebet, those kind of things are taking huge market share across the world, and a significant the tighter regulation gets in established markets, actually the more opportunity there are for them. And then on a B2B, when we look at the stats that we get from clients on a B2B level, the biggest growth is coming from emerging markets, so India, from Africa, from Latin America. Again, the sector is, and that tends to be, relatively new players who are making their mark there, because, the very complex, mobile slots that are built for iPhones in Europe and North America don't resonate there. So it's other game providers who are having that opportunity. So again, ultimately they become targets. So there isn't an end in sight. And I think being in the sector for probably almost 20 years, what you can guarantee is that there will be more challengers coming through who the bigger guys will want to acquire where it makes sense in order to protect their position. It feels like a sector where in certain markets, yes, it can settle down as something of an oligopoly, but on a global basis, I don't I don't ever see that happening, really.
Yeah, I mean, it's interesting. You mentioned the sweepstakes and the crypto businesses there. Some of them are increasing. Well, they are at a very large size already, and there's some resource coming in there. So it'll be interesting to see partly the impact of regulation again on some of those people. What else they may be able to do, really. I mean, Ollie, we've talked a little bit about Brazil, but is there anything else you sort of, in terms of sort of looking ahead in terms of 2025, diversification, anything further, or what are you seeing there?
Yeah, I think in terms of outside of Brazil, wider LATAM, Peru, for example, and Mexico, expect to see activity there. Africa as well is there have been operators that have gone in there and done quite well, thinking of 888, now Evoke, and I think I already mentioned Eastern Europe, but I think globally you're going to still see a lot of continuation of those themes, and I think one thing that might help, and what we've talked about today, particularly in UK and Italy, is some of that regulatory settlement means that there's a bit more confidence in terms of M&A into those markets. France and Spain as well seem at a slower rate to be heading in that direction. So I think we're still going to see a lot in the more, these mature European markets. In the US, it's still very much a challenging market to compete in. And, I think I've already mentioned this. You've got these land-based operators trying to challenge the legacy fantasy operators. And we're still seeing a lot of people pull out of the US because it's just too harder ground to compete. And it really depends on sort of when other states go live and who's going to be in there. Bet365 are another business that are very much focused on sort of market share in the US as well. So there's a lot going on, and I think just from a more stand back, what's going on with the macroeconomic environment and how will that fuel M&A? I think there is a feel that a bit more confidence going into 2025 around interest rates, etc., that will stimulate M&A activity. And in the US, of course, it's impossible to ignore the Trump effect and what that might have in terms of policies, etc., and whether there is a feeling that it will be pro gambling. So that will be an interesting one to watch as well.
I mean, the US clearly a very interesting market. I've mentioned the Jack Pocket deal there, which was at the time the 750 million for a business, which is a very simplistic business, but it just shows the level of player acquisition costs there, and I think that's what they've seen in the room. I mean, these sort of lottery courier businesses, they're called there. There's a half a dozen or so other operators of reasonable size and scale. I mean, when I say reasonable size and scale, as in they've got people, they've got an ability to sort of grow businesses, but these aren't big businesses there. But it's another route to market that's cheaper than some of the marketing spend that we're seeing there. So that's I think it's probably some activity in that space again during 2025. But Ivor, I don't know if anything else looking ahead to 2025 or views or anything else really.
I just reflect on generally how poor the sector has been at diversifying into parallel markets. So if I had to pick one specific, social casino is a market that should be owned by the original gambling companies, and they made various attempts, but it turned out to be owned successfully by somebody else, by other companies. And I think similarly about financials, although there has been some overlap. I remember even when bookmakers owned spread betting companies on financial markets, it just didn't seem to work. And so what was available in terms of a similar customer base, you could argue for a similar risk return profile, ended up owned by different companies. So slightly on my mind, coming ahead of the inauguration of the new president, is just the significance of crypto as a gambling product. I don't mean as a deposit mechanism, but there is an enormous amount of capital, particularly in the US, tied up in digital assets, possibly some of it owned by people who would otherwise have been getting that entertainment from a gambling product. And it's cheap to operate, and there's lots of things you can do with it. So if that is to be more popular, along with other forms of entertainment, maybe that's a continuing sap of revenue away from the more traditional operators. But I've got one specific thing in mind. We've talked about statutory instruments earlier today. I think as soon as the statutory instrument relating to allowing more gaming machines in land-based casinos in the UK is laid before Parliament, that'll be a really good time to own casinos. So maybe that's the one thing one can clearly focus on that's on the horizon.
Just bouncing off one of those points, I think, and we touched on affiliates earlier. Obviously, with M&A, as always, it follows product trends and where the market's going. And I think this idea of more social gaming, whether that's through sports or casino or otherwise, is a massive trend that we're seeing across all operators. And in terms of customer acquisition and how that's done, we're seeing a lot of that now coming through streaming channels. So the likes of Twitch, and I don't know if TikTok's a good example given what's going on with them at the moment, but clearly there's this shift between the wider entertainment space and gaming. But what we're seeing and what we're hearing is that actually the quality of streaming and how that translates into customer acquisition is still quite poor, and it could improve a lot. So I expect to see a lot of focus on that space, and maybe it will fuel some sort of M&A activity as well.
David, closing thoughts? Right. Anything else to add?
I think it's been quite well covered by these guys. I think there is a lot of opportunity in various different places. I would find it difficult to say, this is going to be where it's at, or this is going to be where it's at. I think Ollie's point about affiliates is it is changing, but I don't think it's the death of affiliates. They just need to tweak their business model as they have done successfully in the past. Brazil we touched on. I think later in the year you might well see more deals there. It's a good environment / benign environment. So there's no reason why we shouldn't see, a steady flow of deals throughout the year, with the caveat that yes, anything could happen on a macro level that can always throw things around.
Brilliant. Well, thanks so much to our panelists. It was a really good session. So thanks very much.
Hello, everyone, and thank you so much, everyone still in the room and still with us online. Thanks for sticking with us until this final session. By way of a quick introduction, my name is Daisy Borkflower. I'm a partner in BDO's Corporate International Tax Team, and I'm really pleased to be joined by a selection of tax team colleagues. At the end, we've got Lizzie Preston, who's an Associate Director in our Transfer Pricing team. In the middle, we've got Chris from our indirect tax team, and we've also been joined by Emma Pointer, who's a director in our private wealth team. And in terms of why there's a group of us, we're increasingly finding in this sector, if we talk about one tax area in isolation, we quickly stray into the other areas. So we think it's better if we all come together. And we all work regularly in the sector, whether that's advising B2C operators, B2B suppliers, to even individuals. And we're looking to cover a range of tax topics that we hope are relevant and interesting for all. In terms of what we're kicking off with, we want to start with a focus on UK tax and what's new. And the short answer to that question is there's absolutely lots. Given that we've had a new Labour government come in the UK last year, and the level of media attention that was around the autumn budget, particularly the tax aspects within that, we think it's only right to start there. And a lot of those headlines were around personal tax matters, so changes to the non-dom rules, capital gains tax, inheritance tax. And it's quite easy to think, well, what does that really mean for businesses, and including businesses in this sector? But I think, Emma, given the international profile of the businesses we work with, it's quite reasonable to expect that there could be senior managers or owners who will be impacted by some of these changes, and they could be thinking, well, what does this mean? Do I want to stay in the UK? And I don't know if you want to give us a bit more on that.
Yeah, so tax has never been on the front page as much. And I don't think anybody will have been able to escape the headlines about the non-dom exodus or the business owners or the farmers and what that means for them. And I think there's, as Daisy noted, there's a direct correlation between, owners of businesses and what the business is actually doing, where it's going to be based, and marrying up, the corporate position and the personal position is really important. So just to touch on the non-dom headlines. So non-doms are typically individuals that were born overseas, have overseas parents, have come to the UK for a period of time. We have currently got a very favourable tax regime, very globally competitive with lots of the other, favourable jurisdictions. And that has meant historically that lots of foreign individuals have come here, set up businesses here. Senior executives, management are attracted to the UK because of the tax regime. That's all changing with effect from 6th of April 25, such that we're now not based on domicile, which is a historic concept, but it's based on an individual's residence position. So how much time are they spending here? What are their ties here? Are they tax resident? And you might sort of think, okay, well, that might mean lots of individuals will leave the UK. And certainly that is the case. Some clients will be leaving the UK. Some non-doms will be leaving. But actually, it also gives us opportunities as well.
Make people feel positive about staying in the UK.
Yeah, certainly. So individuals that have been here for a long time are certainly looking at, should I be leaving? But for those individuals that, might come for a short period of time, or for those that haven't been in the UK historically, there's a really favourable new regime where an individual can come to the UK for quite a short period, 4-year period, and any non-UK income and gains that they might benefit from wouldn't be subject to UK tax. They can bring that to the UK freely, wouldn't be subject to UK tax. So actually there is an opportunity for the UK to be quite globally competitive for attracting significant high net worth individuals or significant management teams to the UK. It's still, a very attractive place to do business. And if we think about the global landscape, lots of other territories across the world are tightening on their similar non-dom regimes or their similar regimes for foreigners. So actually, the UK still has a place, I think, for people to relocate to do business here. And we've touched on there the opportunities if people are globally mobile and they've got earnings outside the UK and in the UK. There are various reliefs available, but certainly lots to talk about and lots to think about if there's movement of owners, there's movement of senior management teams. And then I guess from a capital taxes perspective, so that's typically capital gains tax on disposals, exits, and inheritance tax. That's typically on the transfer of wealth to future generations. We obviously had an increase in capital gains tax rates now up to 24%. But if you think about and compare that to income tax rates where the maximum rate is 45%, that's still quite attractive to an individual, a high net worth individual, receiving proceeds on an exit compared to, say, a dividend. And then from a inheritance tax perspective, there's been quite a few changes for business owners, particularly where they're owning a trading business. Previously, if someone died owning a trading business or transferred that to next generation, you typically get 100% relief from inheritance tax. That's very valuable. It's hit the headlines quite a lot, the transition of wealth through families. The government are restricting that from 6th of April 26, whereby there's now a threshold of £1 million, which to a lot of businesses doesn't necessarily hit the sides. And that's certainly restricted as well. So I think what we're going to be seeing is clients thinking about their succession plans, thinking about this transfer of wealth, and what will that mean for future businesses and exit plans for owners and the like.
Thanks, Emma. Really, really interesting, and there's lots more we could say on this. Coming back to some of the more typical tax aspects we see for businesses from a business tax perspective, Lizzie, I feel like from a transfer pricing perspective, there has been more from HMRC in terms of direction and announcements in the last 12 months than there's been in a long time.
Yeah, exactly. So this isn't quite the autumn budget, but kind of very seasonal. So it came out in September 2024. So HMRC have now released guidelines for compliance, which are otherwise known as the GFC, which is essentially setting out HMRC's expectations for what businesses are preparing in terms of transfer pricing. So much more focus on evidence and facts forming the basis, more focus on how everything is implemented. So I think the days of having a nice TP document you did once a year, then got kind of put in the top drawer is over. I think everyone needs to be doing it throughout the year, looking at your policies. The idea is that HMRC want to kind of raise the standard of the documentation they're seeing with the view that it will start reducing inquiries, penalties, sort of bad behaviours. And while this is very much HMRC's expectations, we are expecting it to be used more widely by auditors or in DDs, because essentially it's HMRC saying this is best practice. It's not necessarily mandated, but this is what we think you should have. And in contrast to the sort of compulsory transfer pricing documentation requirements, which just apply to the largest businesses, this does apply to everyone who is in the UK TP rules. And it's not a rule, it's guidance, but it is best practice. So you want to kind of adhere to it a bit.
So Lizzie, you could be a multinational group with a UK subsidiary, and that would be irrespective of the size of that subsidiary, you could be caught by this.
Yeah, exactly. And it's really detailed. HMRC have provided lots of sort of helpful guidance, but the kind of three sort of key areas we picked out which might be relevant to businesses are, there's a new concept of a UK risk lead, which is a sort of individual. HMRC don't define who this individual is. It doesn't have to be your SAO. But if you're the kind of person in your business who is being looked at for TP, this could be used. It's probably relevant. And HMRC essentially are providing a checklist of things you need to be thinking about with respect to your transfer pricing. So, and this comes all the way from the kind of scoping of your documentation. So what's happened during the year? What should you be telling your advisors? How should you be working with them to scope your documentation for the next year? It then goes to sort of what you should be looking at in terms of implementation. So as far as saying you need to make sure you're happy that your finance team are putting through your adjustments properly. Are they being properly trained in how to put through the adjustments and what they mean to your documentation? So this UK risk lead is the person who's saying they're happy with everything that's going in the documentation. There's also a schedule, which HMRC, it kind of reads a bit like a shopping list. It's basically every type of sort of fact, data, evidence you could produce. It's not really practical for everyone to be holding all this data, updating it every year, but it's a good starting point to work through and sort of say, what evidence do we need to have? Because HMRC are increasingly focused on evidence. So things like business plans, org charts, where the people are, rather than the kind of older days where it was a lot more, tell me how things work. Now it's a lot more sort of show me with your facts and what your business is producing. So it's a kind of starting point and then working through and saying what's relevant for our businesses with our UK operations. And then the third piece is there's a sort of list of trigger events, high risk policies, and sort of high risk implementation errors. So working through those annually and sort of saying, have any of these trigger events happened in the past year? So that might be things like, has anyone significant moved to the UK? Has anyone left? Have we introduced a new revenue stream, for example? So kind of working through those annually as part of your compliance cycle, but also if they happen during the year, thinking through it earlier rather than waiting until you're filing your tax return to check your TP is right, essentially. But so that's the kind of GFC in a nutshell. So it's interesting if you work in transfer pricing, but not for everyone. But it's probably more guidance than we've ever seen from HMRC before. And obviously once in the unfortunate event you are in an inquiry and you're looking at penalties, being able to demonstrate you've kind of taken this on board and you're maintaining best practice is a great position to be in terms of shutting down that inquiry or minimizing any behavior-based penalties. A few other things on the sort of TP landscape. So there's a consultation coming in spring 2025. We don't obviously yet know what this is going to say, but we think there's going to be an international dealings schedule introduced, which kind of sits alongside your transfer pricing documentation. So anyone with operations in Australia or Canada might have seen these, and they look very different. The Australia one's really complicated, the Canadian one's simpler. We don't know what HMRC is going to introduce, but we're expecting there to be one introduced and hope it probably looks slightly more like the Canada one. And then also potentially removing medium enterprises from this SME exemption for transfer pricing. So that will obviously be relevant for lots of people who've worked for a medium-sized enterprise, and potentially reforming UK to UK transfer pricing rules. Sorry, I can't read the thing at the back. I guess the final point is the sort of HMRC figures for 2023. So these normally get published mid to late January. So we haven't yet got the 2024 ones, but they'll probably be released today or next week. But showing that sort of tax yield from TP inquiries was up 10% in the last year. So it's a big area of focus. Interestingly, there were only 2 PDCF letters sort of sent out in that year, but we understand that's because HMRC were kind of completing all the ones that had open with the idea there's going to be another sort of flurry of activity in the sector. So we're expecting more PDCF letters to start appearing.
Especially with all of these developments, you've got to expect HMRC are going to continue to really have transfer pricing as something they focus on for large businesses generally, and specifically for this sector.
Yeah, definitely.
Some short other announcements from the budget. Very quickly, the UK corporation tax rate is staying at 25%. The government doesn't intend to move that, so they're sticking with that rate for the time being. From an employment cost perspective, some of the other areas that got headlines, the employer NIC rate has gone up from 13.8% to 15% with effect from April 25. And there's also, which I think is more relevant for a number of our land-based businesses here, there's an increase in the national minimum wage costs. And picking up on things like we've been talking about M&A transactions, if anyone's doing DD on UK businesses, it's picking up these changes in any forecasting. Touching a bit actually on what Lizzie was saying just now, we are expecting HMRC, from what we've seen in the budget commentary, to be focusing more on how they interact with taxpayers. One of the things we know is that there's going to be a consultation and reform around how they apply penalties for bad behaviours, and also the powers that HMRC has in terms of inquiries and corrections. HMRC are also increasing their investment, and they've said that's going to be used to tackle offshore non-compliance. And I feel like, Emma, that ties in with a lot of the changes that you were talking about.
Yeah, certainly. So certainly on the personal tax side, there was lots of announcements around tackling the tax gap. When we touched on crypto earlier, and, there's definitely a focus on individuals with crypto assets, because being digital assets and how they tax, there's lots of individuals that aren't aware of the tax implications there. So there's huge kind of opportunities there, but also investment in HMRC offices as well. And, the landing of the brown paper envelope through letterboxes, I think is going to increase.
Thanks. It's kind of incredible we've got this far into the tax session without talking about indirect taxes. So Chris, with no further ado.
Thank you. Well, for those who listened to me last year, the first thing is exactly the same. A consultation is planned for this spring for a harmonisation of the online gambling duties. So that'll be GBD, RGD and EBD. I have set out what the previous consultation announcement said and added what was announced this year. So changed the year, and they added one final line, which is to aim to simplify, future-proof and close loopholes in the system, which wasn't there previously. So I think that, well, there are obviously many ways to read it into one sentence, but my suspicion is that is a quite big reaction to stuff like the L&L case, where gambling operators have got very good at structuring offers, promotional discounts, marketing materials in a way that is tax efficient, and coming into a way that HMRC don't like. And my strong suspicion is that will be reflected in the consultation. And the simplification will probably mean a movement more towards a GBD style system rather than the free play system in RGD, which has been used for quite a lot of ways to make things more tax advantageous than they otherwise would. So that's one thing to bear in mind. The other legislative point is mentioned by Clarinda earlier, is the statutory levy. So the legislation for this has been delayed. I was told about it yesterday, I think. And it's very, very short. It is clearly DCMS legislation rather than HMT or HMRC. So for tax legislation, it's a levy, so it's not tax legislation. So some of the key factors of that are there is no appeals process. And if you don't pay the levy, you will be the Gambling Commission is required to take away your license, absent some unusual conditions. And there's very little information on how to actually calculate it. Well, there's no information how to calculate it. It is simply revenue derived from your operating license. What that means is, to an extent, I suppose, left up to what's on your regulatory return. I've only seen one or two of those in 2008 for a seaside resort, so they look quite simplistic to me. But as a first step on this, if you're not sort of already aware and on top of it, have a look what's in your regulatory returns, what you put down for your GGY, and how much of that actually is GGY that relates to UK license. How do you treat invoices, especially on the B2B side? How do you treat invoices that are for both UK B2C operators and B2C operators in the rest of the world? Does that all go on your UK gambling license or regulatory return? Because that will all be subject to the levy from 6th of April, likely at 1.1 for most people in the room, but ranging from 1.1 to 0.1%, depending on the exact license you have. And I mean, for the big B2C operators, it's not hugely different in terms of how it works compared to the gambling taxes, although it is on top of them, it's in addition. But B2B operators in particular, who've never usually had to worry about this, this could be quite a big change.
Because I was just about to say, this seems quite seismic for B2B businesses, and presumably there could be some commercial aspects to think about. Say, for example, if you get a revenue share arrangement that's after the deduction of tax, how does this fit in?
Yeah, exactly. So I mean, it wouldn't surprise me if you end up contractual disputes about whether a levy is a tax. We have the contract set out to be net of tax, because it is technically a levy rather than a tax, and it will impact then sort of the revenue going down. You will have tax levy on levy, because the B2C operator will pay it, and then the B2B operator behind them with the rev share will pay it. HMRC or HM Treasurer or DCMS, I suppose, are aware of this. They're okay with that. I think their beginning point with everyone to be paying this voluntarily anyway, so sure, there's not much of a difference for most people.
Thanks. And I'm conscious we've probably got just less than 5 minutes left. We wanted to quickly share just common tax risk areas that we've seen come up quite a bit in our work over the last 12 months. This is across tax advisory work, audit of tax, due diligence. A big one still continues to be transfer pricing, particularly if there's inadequate documentation, whether that's missing intercompany agreements or not having transfer pricing reports and studies that tax authorities actually expect.
Yeah, exactly. I think it's just being aware that more and more countries are bringing in either contemporaneous requirements or filing requirements and penalty regimes, and even countries like Malta, which is traditionally viewed as very low risk, now has transfer pricing sort of rules in place. So it's making sure you do have the right documentation and you know exactly when it needs to be in which territories and what needs to be prepared in that country. And then the other piece is the implementation of policies. So again, it's lovely having them written down. What does this actually mean in reality? And this varies from a kind of really supposedly simplistic cost plus policy where you're not picking up the right costs or you're not allocating them out correctly, to sort of a profit split, which we know is complicated, so needs the time to really sort of focus on how it's implemented. Are the right numbers being picked up? What's happened this year we weren't expecting, and how do we treat it? And again, not doing this post year end just before everything's being finalised and your auditors are coming and asking, making sure you've got this in advance. And I think having that good relationship between tax and finance is kind of key here, and that everyone knows what they're doing and why they're doing it, as opposed to it just being a number to put through in a spreadsheet. I think is really important.
Yeah, definitely agree. We've got exit charge risks up there, and that ties in actually with a lot of what Emma was saying earlier. So we see that a common scenario we see is management might move location. That might be because, similar to what Ollie and David were talking about, there's a strategic focus to be in the US or somewhere else, or simply like a CEO leaves, they're based in one country, the new hire lives somewhere else. And with that, just that moving of the role between jurisdictions can open up a whole ton of tax questions. Whether does that change the tax residence location of a company because management are somewhere else? Does it kind of unravel a lot of the transfer pricing policy existing in place? And then from a payroll or personal tax perspective, where is this individual based? Where should they be paying taxes? So that type of scenario kind of brings all of our tax areas together and is a really common issue we've been seeing recently. Chris, I don't know if you want to pick up on the missed VAT registrations. It's not a new point, but it's one we do see more often than you would expect.
That's probably right. So I mean, it's if you're a B2C operator in the UK still, a few of you out there, just sort of making sure that you are picking up purchases reverse charge, so purchases bought overseas. Even if you're not VAT registered, you likely will become required to be VAT registered by virtue of buying things from overseas. And it's quite a simple point, but it is one we have seen a couple of times this year, so it is still catchable up.
Yeah. And then just on Pillar 2, which these are the minimum tax rules that come in for groups with consolidated revenues above 750 million euros. There's lots we could say on this, but the 2 points we want to bring out here is from a compliance perspective. If you're a UK company with a group in scope, there will be a registration requirement. The first registrations requirements will be for companies with December year ends, and those kick in at the end of June this year. So there is action that needs to be taken. And then we're also, aside from getting to grips with Pillar 2 and compliance and what that means, if you're in scope of these rules, they kind of touch everything that you're doing. So any transaction or arrangement you're entering into will need to be considered from the lens of Pillar 2 and what does that mean for your effective tax rate. And we're starting to see scenarios where there might be intra-group transactions or reorganizations that give rise to dry tax charges under Pillar 2. A really common one is for the intra-group transfers of certain assets. And we've also had some examples where derivative arrangements can also give rise to this. So it's not just a case of understanding what returns and registrations are needed. It will impact almost all transactions undertaken by in-scope groups. Chris, I think we're back to you with some indirect tax.
Different things on litigation happening this year. So probably the big one is LNR Europe, which is being seen by the Upper Tribunal this year, treatment of cashbacks, and more widely treatment of sort of promotional offers and when it's going to be deducted from the RGD calculation. So I referenced this earlier because LNR won, and frankly, the argument, the decision of the court tribunal is pretty persuasive. So it is still up in the air because you have an interesting point where the higher tribunals of the Court of Appeal for gaming duty, so that's where you duty paid in casinos, came to basically the opposite view than the first tier tribunal. So you have two different taxes, so they don't necessarily need to be the same, but it is slightly unusual that you have very different answers to very similar questions across gambling duty. So that'd be very interesting to see. You have Hotel de Tour at Supreme Court, which is very big for VAT generally. It is basically on the recoverability of financing costs or the recoverability of deal costs in relation to sale of an entity, a subsidiary. But more widely, it has qualifications for the recoverability, how you treat the costs of financing generally. So possibly whether that be loans, whether it be sale of subsidiaries, whether that be equity injection. So that's going to be quite big for the UK. And Hippodrome, obviously, a very, very, very large salience for land-based casinos. So it's really determining how you attribute value to your inputs. So how much Hippodrome is actually a restaurant attached to a casino, and how much is it a restaurant in its own right. Opinions may differ, and indeed the first tier and the upper tier tribunal did differ. That'll be very interesting to look at when it comes out. And finally, there's a lot of litigation in the FS sector around when you are established in the UK. So there have been cases with Barclays, HSBC, and their various subsidiaries about whether they're established or not. And this will have some read across to international groups where you are directing services from one hub to another, making sure that actually they're going to the right place rather than being sort of misdirected into somewhere where a VAT charge might arise.
Thanks, Gregory. And then Brazil's kind of been mentioned throughout the seminar today. And for businesses that are entering Brazil, either organically or through acquisitions, I think in terms of the question of how complex is it, there's lots to be thinking about from a tax perspective. It's not the easiest of jurisdictions for tax. And some of the key pieces we've seen come up is, do you need to use a local entity? From a B2C perspective to be licensed, you do need a local entity. For B2B, From a tax perspective, no, but we're seeing a lot of businesses are choosing for commercial reasons to have a local entity, which then brings you very much into the scope of Brazilian taxes. There's a high corporate income tax rate at an effective 34%, which I think then places a lot of emphasis on what's your transfer pricing policy and can you have a controlled level of profits in Brazil. And I think, Lizzie, for Brazil, they're only just starting to follow OECD.
Yes.
The TP.
Yeah, so Brazil brought in OECD sort of transfer pricing principles in 2024. So as well as the sort of this whole sector, the sort of OECD transfer pricing world is a new world for them. So we're expecting it to be a kind of area of focus for the tax authorities, particularly, I imagine they'll be looking particularly closely at what impact it has on their tax revenues. Now they've kind of got rid of their old system and they're OECD compliant. So.
And then finally, taxes. Most of the time when we talk about tax in Brazil with businesses in this sector at the moment, it's about withholding tax and how much is going to be suffered if you're taking cash out of Brazil. Brazil applies a 15% withholding tax for royalties, license fees, technical services. It doesn't have a huge number of double tax treaties to bring those rates down. And where it does have tax treaties, they don't necessarily reduce that rate. There's then the added complexity that low tax jurisdictions suffer a higher rate of withholding tax at 25%. Some of the territories we commonly see in the sector, like Gibraltar, Isle of Man, will be those low tax jurisdictions. Malta, it's our understanding that Malta, even though you can get a low tax rate, the 35% headline rate in Malta is sufficient for it not to be a low tax jurisdiction. But with this focus on withholding tax, I think it becomes a key consideration for supply chains. At what point in your supply chain are you receiving a cross-border payment from Brazil, or are you making one? And how does that withholding tax exposure fit into that for your business? So absolutely lots we can say on Brazil, but I think, Ollie, we're probably at the end of time. And if anyone has any questions on this topic, please do pick up with any of us.
Brilliant. So we'll just wrap up very, very quickly. So thank you very much to all the speakers from today. As I said, we've really just tried to scratch the surface and try and bring out all the things that continue to happen in the sector. So as I said, the slides will go around. We'll have contact details and stuff, so please do get in touch. Thanks also to Tara, who's put a lot of stuff together for today, and Alana, which is not in the room. And as I said, we will be at ICE, some of us, next week. So again, if you're there, please do reach out to us to meet up. And for those in the room here, we have got some lunch, which is back in the room where we had coffee and some pastries before. But yeah, thanks again to everybody online, and thanks to everybody for coming today. It's very much appreciated.